recording all of lectures online?
I will record this lecture. I will announce this. Okay, because the official university closure plan is in effect tomorrow, starting tomorrow, right? Not today, but today, yes, as expected. My expectation was there will be low attendance today. So I decided to record this lecture and upload it to YouTube so that all the people who are not here today can also watch my class today. In the future, well, I would say nobody has such experience what's right? Yes, what's going on in the future. But by now, the university policy is that from the end of the spring break to April 3rd, all the classes will be conducted online. So I would say at the best estimation, this is our last meeting. I mean in person. But if before the end of this semester, if all the classes are conducted online, I will also change the syllabus as well as the grading policy, because the effect of online class is a little bit different from physical class, right? So
How are you conducting the online classes?
so as far as I can tell, by now, this is my decision, and I will update everything that will concern on Blackboard. So you still have to keep a watch on Blackboard. All right.
So how are we going to come to the online classes? How are we doing the online classes?
The online class? By now my plan is to conduct the online class using WebEx. Do you know WebEx? Yes, and I believe you don't have to sign up for account. Instead, you just click the link and install the WebEx app on Chrome, and you can watch it. Well, don't worry. I will post the instructions online. Okay. All right. So let's see. Today we are going to start a new chapter, chapter 22, Master Budget. So master budget, regardless of master, I'm sure that most of you are familiar with this word, budget. And some of you maybe not. So it is a word that is familiar, both familiar and unfamiliar to you. So before I start, who can tell me what do you think a budget is?
It's like a certain amount of money that's like allocated.
Right. It's basically speaking a financial plan, right? Individually, I know some people have a budget on their daily or weekday spending. They have budgets on, okay, how much money do I spend today or in this week or within this month? And after, for example, the monthly budget, after the end of this month, they make a comparison between the budget and the actual spending. if the actual spending is more than their budgeted amounts, well, they may probably lower their spending in the next month. And if the actual spending is less than the budgeted amount, well, they may probably are willing to spend much more in the next upcoming month. So same thing to the business. A budget is a financial plan for a business. So in this chapter, I will discuss what is a budget, the benefits of a budget, and how human behavior influences budgeting. Second, I'm going to discuss the different types of budget. In a business, there are many types of budget. For example, here in this chapter, we are going to discuss what is a master budget. So in addition to master budget, there are a lot of different more types of budgets. So next I'm going to discuss what are the differences between different types of budgets. So next is the essence of this chapter. And as I said in the last class, to prepare a budget for a business is a little bit confusing. But don't worry, I'm gonna explain this preparation process in detail to you. Basically speaking, I will introduce how to prepare the budget for two types of business: manufacturing and merchandising, including operating budget and financial budget for both types of business. So, first of all, what is a budget? As I said, a budget is simply a financial plan that managers use to coordinate a business activities. Managers use budget to basically to develop the strategies. In the long term, they can decide, well, on how my business can operate. Whether to operate to promote the international operations or become a local leader in the local market. And in the short term, the managers would use the budget to make operations decisions. And later on, we'll talk about this type of budget, operating budget. So, after acting, the managers compare the actual results with the budget and use the information to make control decisions, as you can see in this slide. This is a cycle. The cycle describing how managers use budget. They make a budget, they act, and they compare the actual operations with the budget and make decisions or adjustments to improve the future operations. are then based on the formalized plans, which helps prevent bad decision makings. But the budgets are plans for future activities and may need to be modified. And again, the modification process is basically a comparison between actual activities and your budget. So another benefit that is very important for budget is benchmark. Benchmark. So how many of you have heard of this word? Benchmark. Yes, and can you explain what it is?
It's like taking tests to see how you do. Like after you learn something, the teacher gives you tests and it compares to like your results from the beginning to see how much you learn. Okay.
Yes, very good. And one of the important thing for benchmarking is comparison. I would say a budget is the cornerstone of future activities in the business operation. And here in our textbook, benchmarking is defined as the practice of comparing a company with its prior performance or with best practices from other companies. Budgeting procedures to achieve the benefits of motivating employees. The budget should include inputs from all levels of business. So a common method to prepare a budget is called participative budget. Well, it means a budgeting process where those individuals who are directly impacted by a budget will be involved in the budget development process, right? Any person who will be impacted by the budget, for example, the employees in procurement department, they purchase, for example, they purchase raw materials, as well as the workers in the production line, right? The cost for those people are accounted as direct labor cost. In addition to materials, labors, we have manufacturing overheads. For example, the production line managers. Well, all of the people that will be impacted by budgeting are involved in budget preparing process. So this process is called participative budget. The most important part of a budgeting system is getting managers and employees to accept the budget so that the company can reap the planning, coordination, and control benefits illustrated in the, well, the illustration is not here, but it is illustrated in the budget. Well, but one way budgetary slack. A budgetary slack occurs when managers intentionally understate expected revenues or overstate the expected expense. That is to make the budget easier to be achieved. So this is a budgetary gain so that your budget can be accepted by more people. Okay, next, different types of budget. Generally speaking, budgets can be classified into two classes: strategy budgets and operational budgets, where strategy budgets are long-term budgets and operational budgets are short-term budgets. For those people who focus on the production process, yes, they rely more on operational budget. Well, let's see how the amounts in the budget, in a new budget, is relied on. Well, for those who have experience in making a budget, either a business budget or an individual budget, I would ask, what is the base of the current period budget? Most of you would say, well, the base is the amount in the last period, right? Yes, for most business, the basement for a budget is the budget from the last accounting period. But here, there is another way to prepare the budget, that is zero-based budget. It means all revenues and expenses must be justified for each new period. In other words, if the preparation of the budget is zero-based budget, that means the amount on the new budget ignores your previous performance. That is zero-based budget. Strategic and operational budgets, as I discussed in the previous slide. A strategic budget is a long-term financial plan used to coordinate the activities needed to achieve in the long term. Usually, strategic budgets often span from 3 to 10 years. So, because it is a long-term budget, in other words, a long-term goal, usually the strategic budget are not so detailed. Let's see, next, instead of strategic budget, we have a operational budget, which is a short-term financial plan used to coordinate the activities needed to short-term goals of a company. So in accounting, what is the cutoff between short-term and long-term?
So when the accounting cycle ends?
Well, so so you said the accounting cycle, right? Let me ask you like this. How long is an accounting cycle?
Well, isn't it normally like a year? For
Yes,
all
exactly. It normally is 1 year. And in the United States, this accounting cycle is defined from December 31st to the next December 21st, right? So usually it's a 1 year period. Well, as I said, in the United States, the accounting period is defined from January 1st to December 31st. But in some other countries, such as New Zealand, it is not the case. The accounting cycle in New Zealand starts from April 1st to the next end of March. Well, you may ask why. I would say, well, it is an arbitrary decision. Well, next, continuous budget is a type of operational budget that involves continuously adding the additional month as each month goes by. So that means the plan for continuous budget is always 1 year. A budget for a new month is added as 1 month ends. So that means at the end of this month, for example, March, right? At the end of March, the managers would add 2021 April's budget to the current budget, so that the budget is always prepared and developed continuously. That's as the name implies. That is what it means by saying a continuous budget. A type of operational budget that involves continuously adding 1 additional month as each month goes by. Well, next, master budget. As you may recall, this is the title of this chapter, master budget. Master budget is a set of budgeted financial statements and supporting schedules for an entire organization. An operational budget is a set of budgets that projects sales revenue, cost of goods sold, selling and administrative expenses, all of which fit into the cash budget and then budgeted financial statements. Well, as you can see in this slide, master budget means well, everything in this slide. Everything in this slide. the cornerstone of the master budget is the first budget. Sales budget. It projects the sales in the budgeted period. The sales budget. Well, based on the sales, the company needs to make decisions on production. So the next level is production budget. Production budget is based on the sales budget, the first one. Right? We have sales as the output of your production product, and production as the input of your inventory. So that is actually a flow, which is a flow that makes the company alive. Well, in addition to sales budget and production budget, we still have to project the cost. To project the cost, again, as I said over and over again in this class, what are the three parts of a product cost? Right, right. So the cost is divided into these three parts: direct material budgets, direct labor budgets, and manufacturing overhead budget. Once the products are produced, they have to be sold. Once the products are sold, this part of cost moves from finished goods inventory account to cost of goods sold account. So once your products are sold, you have to make a plan on COGS, cost of goods sold. So next level is cost of goods sold budget, right here. Well, in addition to cost of goods sold, we have some other expenses. In addition to the cost, we have some other expenses, such as selling and administrative expenses. So the last level is selling and expenses budgets. Everything in green are the set of operational budget. So as the name implies, the operations in a company includes sell and make products, and to sell and to manufacture the products. This is the flow. This is the basic operation for manufacturing companies. Well, as I said, the green parts are operational budget. What the company focuses on is money, right? So, in addition to operations, we still have to make financial statement budgets, first of all. Well, for a business, it is required by GAAP to prepare financial statements under accrual basis. But all the companies should focus on the cash because they prefer cash flow. Even though the revenue is understated, they prefer cash. So let's see the input of the cash flow is the sales, product sales. And the sales information can be found from sales budget. The output of your cash flow is the cost of products. In addition to the cost, we have expenses. In addition to costs and expenses, well, the companies will also need to spend money to purchase some long-term expenditures to further expand their companies, right? So this is the cash budget. In addition to cash budget, we still have to make the income statement budget and balance sheet budget. Well, in this chapter, I will introduce the preparation process for all these types of budgets, all these types or levels of budgets. So next, let's start this process by looking at the process on how to prepare a sales budget. To illustrate the preparation of the master budget, we still use Smartash Learning Company as the example. Let's assume it is the end of the current year, 2020. At the end of this year, the company prepares its balance sheet listed here, and we're going to use some information in this balance sheet for this year to prepare the budget for the next year, 2021. Well, first of all, the sales budget. As I said, the sales budget estimates the amount of sales revenue, and the sales budget is the cornerstone of master budgets because the level of sales affects production expenses and almost all other elements in the master budget. The sales and market department in the Smartash Learning Company forecast that in the first quarter of 2011 there is a sales of 500 tablets, with each quarter the increment is 50, and the projected selling price is 500. So I believe it is pretty straightforward to understand what a sales budget is. On the sales budget, only two items. Budgeted tablets to be sold, this is the amount. And the second item is sales price per unit, the selling price, with the total amount in for each row and each column. This is pretty straightforward, right? But as I said again, the sales budget is the cornerstone, is the basement for any other levels of budget. So even though the sales budget can be easily understood, let's see next level, the production budget may not. Well, let's see. Production budget is the basis for the product cost, including direct material, direct labor, and manufacturing overhead. But before we have a forecast, a plan for these three types of costs, we need to plan on production level. That is, how many tablets to be produced in each quarter. So here is the formula. We need to plan for the budgeted tablets to be produced. We start from the budgeted tablets to be sold, plus designed tablets in the end inventory. We get total tablets needed minus tablets in beginning inventory. Well, who can tell me why we need some desired tablets in the ending inventory? In the end of the theoretically, in the end of the accounting period, okay, the ending inventory is 0. But in some cases, just in case of increased sales in the short period, we still want some ending inventory left, right? Just in case the increased sales in the short period. In the short periods, the company is not able to produce more inventory to be sold in case of increased sales. So the company determines that the ending inventory for each quarter equal to 20% of the next quarter's sales, budgeted sales. This is how you determine the desired ending inventory. This amount is based on the next accounting period's expected sales. And in this case, we know that this company determines that the ending inventory is for for each quarter equal to 20% of the next quarter's sales. So let's see. For the said, sales budget showing here, this very straightforward one, is the cornerstone of the master budget. So here we know that second quarter budgeted sales amount is 550. So here, the ending inventory for the first quarter equals 550 times 20%. It is 110. And accordingly, for the second quarter, the desired ending inventory is third quarter sales times 20%. Same thing to third quarter's desired ending inventory level. Well, for the last quarter, that is last quarter of 2021, equals 2022 first quarter's expected sale times 20. We look at the next year, if we want to know the budgeted, the desired in the inventory for the budgeted year's last quarter. So this is the production budget for this company. The confusing thing in the production budget is that the total column the confusing thing in production budget is the total column. Total column is not always equal to the sum of the numbers in a row. For example, desired tablets in ending inventory. Here, this number in total column is 140. This number is not the sum of every number in this row. And same thing here. Tablets in beginning inventory. This number here in the total column doesn't equal to the sum of all the numbers in this row. Well, why it happens? And who can try to explain this? Why the number in the total column in these two items do not equal to the sum of all the numbers in this row? Who can try to explain this? desired tablets in ending inventory. So the most important thing is the amount in ending inventory. And same thing here. This row, the title of this row, the fourth row is tablets in beginning inventory. So this row focuses the amount in the beginning inventory. That's why for these two rows, the total number in total column does not equal to the number of sum of all the numbers in this row. So for 80 inventory, the total number equals to the last quarter's inventory, because the last quarter is the end of this accounting period. And same thing, for beginning inventory item, the total number equals to the amount in the beginning period of the budgeted period, which is the first quarter. And also, don't forget that one period's ending inventory becomes the next period's beginning inventory. So that's why we have these blue arrows here. These three blue with zero. Because one period's ending inventory becomes the next period's beginning inventory. These two amounts should equal to each other. So this 110 is transferred to here. This 120 is transferred to here, and this 130 is transferred to here as the beginning entry in the last quarter. So let's go back to the previous slide. As you can see, the format of production budget follows this formula. Budgeted tablets to be sold plus desired tablets in the inventory equals total tablets needed, and total tablets needed minus tablets in beginning inventory, we get the budgeted tablets to be produced. Yes, I would say in the master budget, well, not only in the master budget, but also in all the types of financial statements, the last row is always the most important. So here, what we focus on, as you can see, the last row is budgeted tablets to be produced. So I can say what the production budget focuses on is the amount to be produced in this period. Well, any questions? Production budget. Any questions? Good. Well, let's continue. discussed sales budget, production budget. Well, next level. Three sources of cost of the product: direct material, direct labor, and manufacturing overhead. So let's see each of them one by one. Direct material budget. The format of direct material budget follows this formula. Budgeted product to be produced times direct material cost per unit. We get the direct material needed for production plus desired direct material in the inventory. We get total direct material needed minus direct material in beginning inventory. We get budgeted purchases of direct material. And similarly, I would like to ask why the production process wants a level of ending direct material inventory. Just in case, right? In case of what? Yes, here. Again. Some direct materials are needed in ending inventory. Well, you may recall what JIT is, right? Just in time. Just in time process requires zero ending inventory. Once ending materials, once the materials required for production arrives, all materials are used for production, resulting in zero ending direct material inventory. But for a company that does not follow JIT, they need some ending inventory just in case. First, in case of increased sales. In the case of increased sales, the company would like to make more products, extra products, more than production budget to meet the sales in the case of increased sales period in the next period. Well, another case is that what if some materials are defective? The defective materials cannot be used for production. Therefore, some extra inventories are needed as replacement. Well, let's see. This is the basic structure for direct material budget. The company desires the ending balance in raw material inventory to be 40% of next quarter's budgeted direct material needed for production. For each tablet, 3 pounds raw material are needed. So in the unit of pounds, this is the calculation. For the first quarter, is it the desired direct material needed equals to second quarter's production times 3 pounds times 40%. And same thing for second quarter and third quarter and the last quarter. Okay, let's take a look at the direct material budget. Well, the first row, budgeted tablets to be produced. This information is based on the second budget, production budget, right? 410, 560, etc., etc. For the first row, the amount can be found here. The last row in production budget is the amount of first row in direct material budget. And again, for each tablet, 3 pounds of direct material are needed. So on the second row, we times 3. The third row is the total direct material needed for production. Less plus desired materials in the inventory, we get total materials needed minus direct material in inventory. We get the budgeted purchases of direct material. For each pound of direct material, the cost is given. It is $50. So in the next row, this budgeted purchase of direct material times $50, we get the budgeted cost of total direct material purchased. And also, notice again, in this budget, the numbers for 2 rows in the total column that do not equal to the same thing. Ending and the beginning direct material inventory. For ending direct material inventory, it is the number extracted from last quarter's inventory level. And for the beginning inventory, the number in total column equals to the number in first quarter, the beginning of this period. Well, and in this example, there are two numbers in total column do not equal to the sum. It's 852, which is the ending inventory, and 600, which is the beginning inventory. These two rows. Any questions on direct material budget? Yes?
In that one, it says like at the end that we are multiplying the direct materials cost per pound. And like
Which row? Which row? Which number?
well, is the after the budgeted purchases of direct materials. It says that we are multiplying.
So you
50,000.
can show me by clicking this button.
Oh, okay. So we have these two new lines
Uh-huh.
compared to the direct materials budget, like all of the because in the slide that you gave us before, when it showed us before, it shows up to here, like from here.
Oh,
to here.
right.
And in this
Two-
one we are adding these two.
Yes, because everything in accounting must be counted in monetary unit, right? In monetary unit. So up to here, it is the amount in physical units. But in counting, and especially here in this case, we also need to consider the direct material cost per pound, per unit. So we add this line. So what if in the future it's not 50? It's like it increases from 50 to 60 to 70, right? This is a monetary issue. So that's why we want to add this line. And also the last line, the total.
And so when we are like doing one of those problems,
Mhm.
like in the homework, is that like the direct materials cost per pound is going to be told, or we have to find that?
Going to be, well, the structure, I mean the format of the budgets will be given. Yes, and as you can see in the first exam, I didn't give you those tables, right? But in the next exam or in your homework, yes, I will provide the tables, a black table, and you fill in the numbers. To answer your question. All right. This is direct material budget. Well, next, direct labor budget. In addition to materials, we have labors. And I can tell that direct labor budget is more straightforward. As long as you can understand direct material budget. This is straightforward. Same thing. For the first row, we have budgeted tablets we produced, and this information can be also found from production budget. This information can be found on the production budget. Well, for each tablet needs 3 direct labor hours. So on the second row, we times 3. So the multiplication results is direct labor hours needed for production. Same thing. What we care is a monetary issue. So we add this line, direct labor cost per hour line. Currently, for each labor hour, the cost is $25 per hour. And finally, we get budgeted direct labor cost. I believe there is nothing confusing on direct labor budget, right? Any questions? Direct labor budget. Good. Okay, yes. Next, the last part of this class, manufacturing overhead budget. Manufacturing overhead budget estimates the variable and the fixed manufacturing overhead needed to meet the company's production needs. The predetermined overhead allocation rate. I believe you're not unfamiliar with this concept. This concept is learned in activity-based costing chapter. That chapter, predetermined overhead allocation rate. Again, it's used to allocate the indirect overhead cost to tablets produced. So let's take a look. For variable parts, the variable overhead is $20 for each tablet produced. Variable parts at first. Same thing. This information budgeted tablets to be sold, to be produced can be found from production budget times the variable cost, which is $20 per tablet. We get the budgeted total variable overhead. In addition to variable part, we have the fixed part, including the depreciation, utilities, insurance, and property tax. Well, who can tell me, this is what we learned in financial accounting class, who can tell me why do we have to separate these two parts, depreciation for one single line and the rest of the expenses for another single line? Why do we have to separate depreciation from utilities, insurance, and property tax? Well, because depreciation is a non-cash payment expense. It is an accounting expense, but it does not require cash payment. Instead, utilities, insurance, property tax require cash payment. So that's why we separate depreciation apart. Okay. Variable plus fixed overhead, we get the budgeted manufacturing overhead costs listed here, and divided by the cost driver, which is direct labor hours. We get the predetermined overhead allocation rate. So in this case, it is the total budgeted manufacturing overhead cost divided by total direct labor hours. It is $23 per direct labor hour. This is the allocation rate. So you may ask, how can you find this amount? Well, I would say this amount can be found right here in direct labor budget. This amount. And finally, we get the cost of goods sold budget. Direct labor cost per tablet is straightforward, 150. Direct material cost for each tablet is straightforward, 150. Direct labor cost is 75, which is also straightforward. Lastly, we need to calculate the predetermined manufacturing overhead rate. That is 3 direct labor hours per tablet times $23 per direct labor hour. We know that for each tablet, the manufacturing overhead cost is 69. In total, $294. So according to this information, we can prepare the cost of goods sold budget. For the first month, as you may recall, the expected sales is 500 with 50 increments in the following quarter. But for the first quarter, the first 200 tablets are the cost from the previous year. Oh, I need to mention that this company uses first in, first out costing method, FIFO. First in, first out. So the first 200 sales are the cost derived from last year. And for this year, the cost, as we calculated in the previous slide, is $294. So for the second, third, and fourth quarter, this amount is straightforward. That is 294 times the expected sales amount. But for the first quarter, the beginning 200 tablets are cost from the last year, and for the rest 300 tablets, the cost is 300 times 294, which is the cost for the current year. So the last part, selling and administrative expense. Same thing. We separate the expenses we classify the expenses to fixed and variable. For fixed, we have salaries, rent, insurance, depreciation, and for variable part, we have the supplies expenses. So according to this classification, we get this table. Pretty straightforward, right? The only difference is the variable part, supplies expenses. This is the only variable part. And in this budget, the total column, the number in total column always equals to the sum of all the numbers in this row. And also, it's true to the total row. Total row, the sum of these columns. Here. Well, okay, this is the end of this class, and in the future, I will explain how to prepare the financial budget for manufacturing company. So I will